Good afternoon, everyone. Thank you so much. We bless God for a time like this in Nigeria. I have a few minutes to deliver my paper. Okay, thank you. I'd like to give you a question, and maybe I'll give you an answer as well. What is credit? Don't answer me. I will answer it for you. All right? Is it okay? Is it okay? No? Better? So give me a better microphone. Yeah. Okay? Better? Okay? Better now. Okay, thank you. So I want to start the delivery of my paper by asking you a question. What is credit? Leave me to answer it. Credit simply means buy today, pay tomorrow. Buy today, pay tomorrow. Under agreed terms and conditions. It's as brief as that. All right, let me also quickly take us to the body of this paper. What is credit economy? I've given you a definition of what credit is. Buy today, pay tomorrow, under agreed terms and conditions. Then what is credit economy? It is an economy where trust is monetized. It is not just about money moving, it is about promises moving. All right. When a bank, supplier, or investor gives credit, they are simply saying, I believe in your character today. I believe in your character today will produce cash tomorrow. That's what they are saying. And so we are not lending to collateral or relying on a guarantor. We are using character, capacity, and cash, the cash flow, to calibrate the economy. When SMEs, manufacturers, or farmer takes credit, they are simply saying as well, I give you my word that I will pay back. Credit turns a promise into a contract, and a contract into economic growth. Right. Therefore, credit managers are not just managing money or using credit to sell manufactured goods or products. They are managing other people's character. As credit managers, what we do, we assess, will this company or individual keep to their word? We structure. How do we protect that promise? And then we enforce. What happens when the promise is broken? If character fails, the economy fails. If character is rewarded, the economy grows. Right. The two-part way that Nigeria is facing right now are this. Nigeria want to continue to operate economy on cash and carry system. Now, the cash economy is asking us question, what do you have now? And the economy is asking us its own question. Credit economy is asking its own question, what can you become tomorrow? So you compare these two. The choice is right there for us to make. Today, we address the single biggest constraint to Nigeria's economic growth: governance in credit system. Capital is available, but trust and structure appears to be missing. This presentation outlines as a prelude 4 governance expectations to unlock a true credit-based economy in Nigeria. A credit-based economy is not built by capital alone. It is built by governance. Governance of law, governance of data, governance of people, governance of culture. It is most efficient engine for capital allocation, enterprise growth, and financial inclusion. But capital without governance creates bubbles. Governance without capacity creates stagnation. Let me hit at 4 governance expectations required to unlock Nigeria's credit potential. And this I will put in form of questions and answer for clarity in the first instance. Question 1. What is the legal foundation required for a credit-based economy to function in Nigeria? The rule of law, the Secured Transactions Immovable Asset Act, Banks and Financial Institutions Act, BOFIA, NICA Act of 2022, and then strong credit economy, strong credit system. Now, I'd like to take our talking point. No economy can be credit-based if lending institutions and credit-granting manufacturing companies cannot create and extend credit to their customers and ably recover their monies. Secured Transactions in Immovable Assets Act of 2017 must make movable assets bankable. Banks and Other Financial Institutions Act, BOFIA Act of 2020, Credit Tribunal must ensure speedy debt recovery. That is very important. The NICA Act of 2022 must be respected as the statutory professional credit management ethics regulator, control, supervise, set standard, and train those managing, approving, and utilizing credit for business expansion, business growth, business startup, and consumer credit administration support. The expectation of governance here is certainty. Credit providers and grantors must know that a perfected security interest means something. In the world today, countries with strong secured transaction laws have 15 to 20% higher MSME credit penetration. You can see example of some other countries, such as Mexico is doing well. The statistics is there if you are transmitting this paper. Colombia, or rather Ghana, let me say here, Mexico, SMEs in Mexico as a percentage of total lending moved from 18% in 2005 to 34% in 2015. Mexico's registry allowed banks to to lend against inventory and receivables. MSMEs lending is doubled. In Ghana, registered over 400,000 security interest in 8 years. MSME loan approval rate rose by 17%. First African country to show STMA impact. Banks in Ghana now accept cocoa, equipment, and stock as collateral. Rwanda is about 12 to 13% between 2012 and 2019. Colombia is about 22% to 41%, which is about a 19% jump. In Kenya, 1.2 million capacity or security interest registered. 1.2 million in 3 years. Fintechs and SOCO now lend against tractor, vehicle, and warehouse stock. In Nigeria, before SME 2017 Act, less than 10% of MSMEs could access bank credit because they had no title. Right. Presently, again in Nigeria, after the STMA and the National Collateral Registry formation, over 1.8 million financing statement has been registered. Banks and other financial institutions are now lending against trucks, generator, farm produce, and receivable. That's a good development, isn't it? Time is now to make Nigeria a credit-worthy nation and a credit-ready people. Time is now. We can't delay any further. A resilient nation is built on a resilient credit. Until we correct the structural anomalies I am going to talk about in this 15 minutes presentation, Nigeria's economy will remain fragile, exclusionary, and cash-bound. A nation cannot industrialize on cash. A nation cannot scale MSMEs on goodwill. A nation cannot attract investment on opacity. It's not possible. Now let me look at the cash and carry mentality that has come to live with us for a very long time. Thank you. Over 80% of economic transactions are still cash-based. Collateral-based or collateral-based credit is treated as a favor, not a right. What damage has that done to us? It starves growth, it excludes the bankable, poor, and credit-worthy SMEs. It keeps our GDP trapped in low velocity. What correction can we bring here? Industrialized credit reporting system, institutionalized credit reporting system, create credit scoring mechanism, and professional credit management as the default for all commercial transactions in the country. Absence of professionalized credit management practice. We have a very disturbing anomaly there. Credit decisions in corporates are made by non-certified credit management personnel using sentiment, not science. And what damage is that doing to us? Non-performing debts rises, fraud proliferates, and credit granted retreat. The cost of credit becomes punitive. What can we do here? We look at the Act and see how we can implement the mandate that the law has given to the National Institute of Credit Administration. I am running out of time, and let me speed up to area I want to look at the strategic imperative. Then I will give space to the panelists to look at what we are talking about. The strategic importance in relation to the establishment of a command center for credit transaction initiative or activities industry-wide in the country. There is a huge gap that is creating the difficulty in harmonizing the activities of the credit institutions we have in the country. I am proposing here that the National Office of the National Credit Officer should be established. You will read the full detail in the body of my paper. The acronym is NCCO, to become the single point of authority to coordinate all credit-related agencies, institutions in all sectors of the economy. No more agencies, multiple agencies doing credit with no data sharing, one policy, one data, and one standard. The time is now to make Nigeria a credit-worthy nation. A national chief credit officer is hereby advocated to coordinate all of the activities of other agencies of government whose internal process and procedure hardly enable them to remit information required in various sectors of the economy that runs their businesses on credit. Who bears the primary responsibility for quality and portfolio outcome? As I said before, let me just quickly move on to the end side so that the pressure on me right now will be, I'm seeing a paper here that my time is gone. All right. And so we need to see credit working effectively and not the market to undermine the integrity of the credit system. It is going to be connected to how governance is really keeping the credit flow in our system. And so we look at three scenarios here. The credit failure is really a market problem as we speak in Nigeria. It is a governance problem. It is board problem as well, because we do not need the rubber stamping approach of some board members to the issue of credit. They need to look at it very thoroughly. The expectation is that credit committees in companies, in institutions, are chaired or advised by competent credit management professionals, and also in accordance with International Financial Reporting Standard Article 9, with expected credit provisioning to be within certain range. The credit risk-based pricing must be compliance exercises. They must drive decisions. Governance demands that we reward portfolio quality, not just loan or credit sales volume. That is very important. What infrastructure is required to scale credit safely and inclusively? Integrated credit information system and functional secured transaction framework. You cannot have a modern credit economy in a fragmented data. The expectation is full participation in the use of credit bureaus and compliance with NICA Code of Professional Ethics. Every telecom, lending institution, credit granting company, utility biller, fintech, and landlord must report transactional activities to Credit Bureau. Equally, the National Collateral Registry must be mainstreamed, and so that inventory, receivable, and household equipment becomes real collateral. Governance must close the gap and as well as the collateral or security gap. We must have to do that. It pays to do that. Now, the final governance expectation is cultural. We must move from a culture of credit as entitlement to credit as contract. This comes with educating credit grantors, credit takers, and credit regulators, a more ethical delinquent account recovery approach, and consequences for willful credit default must be prioritized. It also means rewarding good credit-using customers with better pricing. Governance must protect trust because trust is a currency of credit. I won't say that. I'd like to extend my invitation to corporate governance directors here. You sit at the board table. You approve or decline credit transaction proposal. You set the tone. If credit governance is weak at the top, the entire economic bleeds. Do not delegate professionalism, embody it. Get chartered. Lead by example. Secure the boardroom. Secure the nation. Become a fellow of NICA. Nigeria's journey to a successful credit economy can only be achieved if you take your place as a fellow of the National Institute of Credit Administration. Now, my closing statement. Unlocking the potentials of credit-based economy is not a funding question. It is a governance question. Get governance right, and capital will flow. Thank you.
Thank you very much, Prof. Please, can we give Prof a huge round of applause? Thank you so much, sir. Please, can you have your seat? Good afternoon, ladies and gentlemen. We have just about 30 minutes. Yes, sir. Please, over there. Thank you. We have just about 30 minutes to run through this panel, and I'm going to start from where Prof stopped. We'll just go right into it. Pending when governance practitioners become members of NICA, like you have advocated for, I'd like to ask you, Mr. Okando, how do we strengthen governance at the leadership level so that credit decisions consistently balance growth with prudence, accountability, and long-term sustainability?
Thank you very much. Also, piggybacking on what Prof said,
yes.
I'm a fellow of NICA.
Oh, wow.
And happy to have Prof on our side today, where we are the ones on the field and they are the ones training us, and we're collaborating together to make the economy and the finance sector saner from a credit perspective. So there are several factors that coordinate together to make credit governance something that is not just a theory.
Can you give us a few because of our time?
I will. So one of them is a proper credit system from credit giving institutions, right? Professional, we all know what it is. Getting very professional around your credit decision making. And it's also how you manage the credit after it's been given. We recently saw, and I'll give a real life example, where the central bank decided to raise the governance bar by forcing banks to take away, to make direct provisions for forbearance. And what is forbearance? Something that is bad. A credit that has gone bad over the years, and the regulator said, I will look the other way for a while, allowing you and your creditor or the borrower, the debtor, to keep negotiating. And what did that lead to? An elongation of the credit cycle. None of those debts that were in that bucket really got accelerated to pay down. But once the governance temperature increased, you saw the banks doing the right thing. You saw the economy reflecting the credit losses. All the banks had to take huge losses as a result of that. So that's just an example of one of the actions that needs to be taken. So all the way from origination to monitoring and eventual pay down, the governance temperature, the governance standards, everything needs to be very professional. And then we have also seen a maturity of the credit system where name lending has gradually taken a back seat, where the banks are forced to give a loan to certain people because of the name they carry. Those are taking back seat. Those are taking backstage. And as the economy and the governance supporting structures continue to strengthen, we'll see an expansion of credit.
Thank you very much. That is really music to my ears. That is really music to my ears. I'll address you as Lady Tinu, the way the MC addressed you, okay? And in your view, I'd like to find out from you what legal or institutional governance reforms Nigeria should prioritize over the next few years to strengthen confidence across the credit ecosystem.
All right, good afternoon, everyone.
Good afternoon.
My name is Tinola Aigwedo. I work for National Credit Guarantee Company. I must also start by saying I'm also a fellow of NICA, and I can only but agree to what Professor has spoken about. Looking at a credit-based economy. A credit-based economy would not only rely on capital, but will be built on confidence and trust. Now, I mean, as a lender, if you don't even have confidence in the system, there's no way you can extend credit. You must have confidence that even the legal system is on your side, that the legal system is here to support the borrowers and the lenders. Now, the three areas I would say Nigeria needs to prioritize is, number one, the judicial system, in terms of how commercial disputes are treated, how they're resolved. I mean, looking at my banking experience, I know that the major challenge then, and I'm sure it's still there, is the way cases are being treated in the courts. They're there for years. So you don't even know how soon you will get these issues resolved. So we need to prioritize reforming the judicial system to ensure that disputes, credit-related disputes are treated immediately, because with that, the lenders will have more confidence to lend to borrowers. And then two, even looking at the institutions we have, you have the regulators, you have the financial institutions, you have collateral registries, you have credit bureaus. Everybody must work together. We're all looking at the same goal. If we're able to coordinate better, we share information better, I mean, lending won't be that difficult. I mean, with the information we have, we can use it to avail credit, especially to the underserved. Thank you.
Thank you very much. And there's a message, or there's an assignment for those of us who have access to the judiciary in the room. So we see the role that judiciary needs to play to ensure that the credit ecosystem in the nation is further strengthened, and all that we're talking about actually. Can you hear me now? Yes. So the judiciary has its role to play, and please let's pass that message on. And I will come to you, Mr. Ashagun. Ashagun, all right, I got that. So quickly, tell us in a few minutes what practical steps are required to build a national culture of responsible borrowing, responsible lending, and ethical credit behavior across both institutions and individuals. What practical steps are required? We need to build culture.
Okay.
Do we need to know, and how should we go about it?
Thank you very much for having me. And I'll also say that I'm a fellow in NICA too. So I think we have 3 fellows here.
What's going on?
Yeah, because we are credit administrators. You see, we can't get our credit economy right if we don't get assessed. When it comes to the assessment of credit, we need to be able to get it right. And we have to have qualified people who are professionally trained to be able to do this.
Yeah.
Now, we operate in what you will call the underserved community. And I can tell you for free, what we currently operate is a trust-based system that is not sustainable. Now, we borrow to the micros and the small businesses. I won't even, I probably would just, okay, let me just add the medium to it. But basically, just the micro and the small. And what happens at that level is whatever we avail to them is strictly on trust. Yes, we do our due diligence. We collect all the securities we can, but trust me, those securities will not guarantee anything. For me, what I'll say is this: we need to have a rethink on our policies. There has to be a policy that ensures that people are held accountable. Because if we need to grow, the current government is talking about $1 trillion economy. We can't achieve that if we don't go to the informal sector. It is at the informal sector that we can actually grow the GDP. This sector currently adds more than 50% of our GDP. We have more than 40 million MSMEs, individuals that run their businesses without any form of support or capital that is availed from either the government or even from MFIs or from MFBs. So we need to have a policy that ensures that people are held accountable. And how we can start is for the government to enact policy that would ensure that lenders like us have confidence in the system to say that if I avail credit to a particular borrower, I'm sure that that credit will be returned to me as agreed. Now, what you find is that after doing our due diligence, even at the level which we operate, most times we have a few PDOs, we have a few credits that go bad. When you go to the police will tell you, we are not involved in credit issues and all that. They will tell you to go to the court. Now we get to the court. They will tell you on a micro loan of 100,000 or 200,000, they will tell you come tomorrow. You will get a lawyer. That's not an effective way to recover loan at all. So we have a system that says we have like a policy that allows confidence in the system to say if you avail credit, the borrower must be held accountable and fast also. It's not going to like linger forever. Then you will come to the credit administrators. Like we said, we need to have qualified credit administrators. We need at every level of administering this credit, we need to be professional about it. We need to do our due diligence. And then, both on the governance or the law or policy aspects, and even the credit administrators, I would say financial education. In my organization, what we don't just avail loan only, we train and we talk to the people we avail this credit to be able to use the credit we avail to them in the right way. We don't just avail credit. We sit down with them, we look at their accountability structure, which most will not allow most commercial banks to lend to them because they don't have a seamless accountability structure. So we try to create one for them. This is how to keep your books. this is what you must do. You must be able to know your cost, you must be able to know your sales, and then you must be able to know the margin that you're going to get in at the end of the day. This aspect, this margin will come to us, and this is what you're able to retain. So both the policy and the administration of credit should be able to train these borrowers on how to administer the loan that we give to them in such a way that they are not mixing things together. You know, most times in Nigeria, you don't know the difference between the finances of the owner of the business and the company that they run. So this has to be in place for us to have a robust credit system that works in Nigeria.
Okay. Thank you very much. Prof, very quickly, in 2-3 minutes, you did propose that the office of a national chief credit officer be created to coordinate Nigeria's credit ecosystem. What practical policy and institutional steps should government quickly take in the next 12 months to make this policy a reality, if at all it's going to go in that direction? What steps? Quickly.
Thank you. I think things should work a bit faster in this country. The mastermind of such ideas should be able to develop a brief on it and then move quickly to the government to get the executive bill, executive order of the president, actually bringing out the existence of that body, and then followed by a bill to the National Assembly. The reason is because we need to have, it has been identified by stakeholders themselves that we need the one command center to collect information to be able to deliver a new credit economy regime to the country. I think it depends on the people who are conceptualizing the idea for that CCO office, and then moving very quickly, working with the presidency to be able to do that. I think within 90 days, we should be able to have Chief National Credit Office operating in this country to help the critical stakeholders. But I think we need to speed up how things work at the government level. It will require the process of getting the executive order, which is a Herculean task. It also required the National Assembly, the bill passage is tough, and then come in to meet the stakeholders, you know, before you get just office statutorily established to deliver its mandate.
What I'm hearing is that your institute has its work cut out for it, more or less.
Well, this is professional view of our institute, and we would like to work with critical stakeholders to put the process,
push this through.
Push it through. I think it makes sense that way. But as for the need for it, the gap is there so that we can build a new, my friend there was talking about public awareness creation. I think the credit defaulting system in the country, we are not looking to have courts ready to entertain cases. What is important is to create awareness, getting Nigerians to know credit obligations, what to do to be credit ready, and then what information. They need to really structure themselves as an individual and corporate organization as well, to be able to have a very strong credit culture system that will support the credit institution. The NCGC is here, and they will, what we are talking basically is for their best interest, the best interest of the banking institutions and any institution that is pushing out credit, whether consumer credit or goods credit that drives the sales of goods produced by manufacturing companies. And let me make this very clear, the credit system is not only situating in the banking industry.
True.
Okay, the cloth we wear, the shoe we put on, all the items we are using to communicate right now were produced en masse using credit. So we are talking about credit across the economy, in all sectors of the economy. And to achieve that, you need to have at least Office of the National, Chief National Security officer to be able to coordinate. It's not a duplication. Some people may be thinking, oh, we have a lot of agencies already.
Yeah.
But there's no need for that. There is need because data sharing is of a huge gap. It's
Yeah.
not there. And then creating awareness down to individual. We're looking at business credit, but when you come to the consumer credit, you see that Nigerians are not even ready for it. You talk to someone, take money, go and borrow money. Fintechs, money lenders are everywhere. Take the money against your monthly income. They'll tell you, no, I don't want to borrow money, which, of course, suffocate our drive for national wealth creation and job creation.
Okay. You know, when you're dealing with a professor in these matters, you need to pay attention. And by the time we're done, we're all going to be creditors. Okay. Mr. Ukandu, looking beyond traditional lending, how can stronger collaborations between commercial banks, development finance institutions, and capital market participants create a more resilient and diversified credit ecosystem?
Thank you. That's a very good question. Yeah, because the way you've articulated it has also helped us draw a sort of holistic picture of
Yes.
the players in the credit ecosystem. Because once you hear credit, you tend to think commercial banks, microfinance banks, and more recently, fintechs.
Yeah.
Right? But the capital market is also involved in credit. Development finance institutions are also involved in credit. We also saw a situation where the central bank was directly involved in credit. Though what we were taught in school was that the central bank is a lender of last resort and that it transmits its policies via the bank. So, but it's because of the various dislocations in our economy that they decided to cut through those layers and come directly to be interfacing almost with lenders directly. We've also seen institutions like BOI doing something similar. But what must happen to unlock this credit that will drive our economy forward is collaboration in data sharing, which is becoming more apparent with the credit bureau systems, where it's going even beyond the entity name for a corporate to the promoters and the directors. So today, if an entity wanted to borrow money and one of your directors is owing money on his credit card, the institution cannot get the money today. That's the extent of sophistication that is in the market. Or if you used one business name to get a loan from Bank X and you go to Bank Y to borrow with a different business name. Today, the strength of the credit bureau system and the data management that we already have in the system will make sure that the other bank searches the database to find out your credit health in order to stop that. We've also inadvertently benefited from the identity management system that is also growing in parallel. We have BVNs that is identifying each person that's interacting with the financial system in a unique manner. We also have your NIN, we also have your mobile phone number. These are all unique identifiers that are tying you up. And we also see that these same numbers, the stockbroker will ask you for it. The asset management company will ask you for it. The credit. So that is a basic level. The next step that we need to take is, so today we talked about NMSME. There are different numbers flying all over the place.
Yeah.
One of the economies that we use as a poster boy for massive development over the past 20 years is China. China grew on the back of credit. State-owned banks financing MSMEs directly. And those MSMEs have grown into multinationals today. They only grew because the institutions, the legal system was strong, the data management system was strong, the logistics support system was strong, and the basic infrastructure was already there. So we will be paying lip service to it if we think we can fix credit without fixing power. Power is critical to ensuring that the cost of credit remains low.
Yeah.
And the producer or the manufacturer who has borrowed from you is able to make enough margin to pay back. So it's a multiplicity of various factors that would also commence from sponsoring the right bills, strengthening the legal system, strengthening the judiciary, and empowering MSMEs, mid-tier corporates, large corporates,
Yeah.
conglomerates,
Yeah.
and multinationals. Thank you.
Wow, thank you so much. I think we deserve a round of applause. Guarantee institutions, Lady Tino now. Guarantee institutions play an important role in expanding access to finance, okay? How can guarantee schemes encourage greater lending to MSMEs and productive sectors without weakening prudent risk management and governance standards?
Okay, thank you very much.
Yeah.
Maybe I should put a bit of concept to why the National Credit Guarantee Company was set up for the people that don't know in this room. So part of the president's renewed hope agenda is to ensure that MSMEs have access to finance. And the only way MSMEs can have access to finance is to go to financial institutions, fintechs, to see how they can access credit. Now today, most commercial banks will say you have to bring some form of collateral. So we're saying to you that whether you don't have collateral, whether you don't have, or you have weak collateral, we're there to support with our guarantee. We would share the risk with the financial institution. Now, sharing the risk, we understand the moral hazard. And that's how, that's why a lot of commercial banks are telling us that, okay, so if they give out the loans and we share the risk with them, how are they sure that we would give them back the money? Yes, we have our capital, but our capital is not meant to be eroded. So we also have to do our own risk assessment to be sure that, yes, this business is viable enough for us to lay our guarantee behind that credit. So we tell the PFIs that give out the loans. If there's a default, come to us. We would give you minimum of 60% of the principal that you have given out as refund. What's more? But at the same time, that doesn't mean that they should not do their work. So they have to also be prudent in lending. And, we go as far as even looking at their own credit appraisal. If we look at the credit appraisal and we're not comfortable with it, we go back to them because we don't want a situation where they don't have a skin in the game. They must have a skin in the game, and that's why we're only taking 60%. We can actually go as high as 70%, depending on how productive the sector is. And what we also do is we try to encourage them to lend more to the productive sector, because those productive sectors, the MSMEs that don't even have the collateral, are the ones that will help in terms of economic growth and economic development. So we understand that the moral hazard part of it, and that's why we also do our own risk assessments. We also monitor to be sure that the PFIs are doing what they're meant to do.
Thank you very much. Very quickly, Mr. Saju. Help me. Ashagun, all right. Financial inclusion should ultimately lead to sustainable businesses. How can lenders better combine access to finance with financial education and governance support to improve long-term business success?
Okay, so most businesses just think that the only way they can achieve success is by borrowing.
Borrowing.
Just being accountable to yourself, your own corporate governance, can actually reduce your lending by as much as 50%, or your borrowing rather, to as much as 50%. So what we try to do in my organization is, or in our organization, is to educate our customers to be able to govern themselves in such a way that they are accountable. Now, you don't have to go get an accountant and all that. We all have done businesses before, and some of us are currently still in business.
Yeah.
We're saying that even before you get to the point where you're getting the CFO and all that, you should be accountable to the point that you know what your cost is, you know what your sales are, you know what your margins are, and you should be able to use whatever you have been availed, or even what you have, use it judiciously in such a way that you reduce borrowing. Now, I'm going this route to say that a lot of time, businesses can grow organic. When you grow organic, what that means is that you're reinvesting whatever it is you make, profit. When you have your revenue, whatever profit you have, you should be able to reinvest. You should be prudent enough not to spend. We have a lot of overspend. You have a lot of CEOs who just dip hands into the company coffers and spend anyhow and whenever they feel like, without proper accountability.
Sad.
Now, what that means is that when you spend like that, let's assume you need 100 million to scale, for example.
Yeah.
You're spending, you can't control your own appetite for expenses
Yeah.
on a personal level.
Yeah.
You can't achieve business success that way. You need to be able to limit what you spend and, be able to push forward gratification. But we want instant gratification. So if you're able to reduce your spending, your expenditure, you look at your costs, you know things that are able to take money away from the system, and you're able to curb that, what you find is that you're able to grow organic in such a way that if, for example, you need 100 million, like I said, you probably won't end up borrowing more than 50 million because you in-house have been able to save that margin,
million. Yes.
the 50 million.
Yes.
So, yes, we encourage that they should be accountable, they should be prudent, but that also translates into the business growing organic and the long-term sustainability of such businesses.
Thank you very much. Thank you so much. We are rounding up now. Prof, very quickly, your closing statement, please. We'd just like you to tell us what are those things that we should expect to see in the next couple of years that will tell us that, yes, Nigeria is really on the right path with regards to a credit-based economy.
Agreeing the country is already on the pathway to launching into a main credit-based economic activities.
Yeah, okay, so what will we see?
Now, we want to see the effect of this in the manufacturing sector.
Okay.
That there's much more credit allocation
Okay.
to the manufacturing sector. We want to see a higher percentage of credit flow to MSMEs. We also want to see the Nigerian consumer credit system picking up very fast through proper credit worthiness modeling for individuals. And then we also want to look at how Nigerians can raise the young people, moving into setting up their own businesses, creating job and wealth for the country so that unemployment can shrink and the country can rise to export market. We still have a lot of markets around the country, around Africa that Nigeria needs to produce and sell into those markets.
Yes,
so we want to see this impact, in the next couple of years to launch Nigeria into the mainstream of global credit economy, which in turn attract foreign investment into the country.
Thank you very much. A round of applause for Prof, please. Last word, Mr. Okandu, please. Last word.
Thank you. So one of the things that would propel Nigeria to expansion of credit across different sectors is what we're doing today, governance. So we need to see institutions that enthrone governance, that have independent directors that can question management strongly. We also want to see an economy where the regulators and the institutions that are interacting with the system are given a free hand to punish, to promote, to reward, and to take down whoever without interference.
Thank you very much.
That would help sanitize the economy. Thank you.
Thank you. Your last words, Mr. Shagun. Last words.
All right. I want the government to give lenders confidence that when they lend out money, the borrowers are going to pay. And timely too.
Thank you.
Thank you.
Thank you. Lady Tinu, last word.
Okay, I see an economy where trust will be able to replace collateral.
Thank you. Thank you very much. Please, can we put our hands together for this panel? So we see that a credit-based economy is possible here and now. And it takes good governance, it takes trust, it takes education and confidence in the government of the day, and it takes what? Legislating on the subject of credit for all of this that we have discussed this afternoon to be possible. And I don't know if anybody has any question in the room. Oh my goodness. Wow. Okay, if you have a question, please raise your hand up. I think they should just pick, yes, give them numbers and we take the question. If you have a particular person you want to answer your question. Wow, wow, wow. Okay, quickly, please, can we go around with the mic? Number one, who's number one? I think we should take 3 questions and then we'll answer and then we'll take the remaining, okay? Or should we take all the questions? Okay, we should take only 3 questions. Okay, we'll take 3 first and then we'll take another 3. Okay, quickly, please just go straight to the question.
Thank you for the session. I have 2 questions. The first one is for Mr.
Ashagun.
Yes, please. So he says, when they have to go to court to recover bad debts, it's slow, the process is not encouraging for his business. And the question is, what do you recommend as an alternative that would, be better for your business in that regard? Then the second question is to Madam Tinu, right, who is with the National Credit Guarantee Company. Now, she says that the company shares the risk with the lender, right, by providing a guarantee that the borrower will pay back, after, of course, conducting their own risk assessment on the borrower and recommending that the lender gives money to the borrower, gives credit to the borrower. Now, this sounds like a charitable cause. The question is, how does this company make profits? While sharing the risk with the lender, do you also share profits with the lender? Thank you.
Good question. Question number 2.
Yeah, quickly, 2 questions. The first one is, how do we reduce the lending rate? Because that's what's putting many people in trouble. That's why you don't get people paying back what they owe. Japan is already almost having a protest because of 1%. It went to 1% in Japan. In Denmark and Germany, it's 2% to 4%. So in Nigeria, minimum is 30%. The microfinance houses is 48%. So I don't know what the kind of business you want to do and pay that one, number 1. Number 2, when you are lending, I'm a lawyer. If you don't want problem, don't go to court over money. Get people who are going to be guarantors who can be able to vomit your money. Because the court is so, even we lawyers, we are going for arbitration and mediation now, not litigation. Thank you.
Number 3.
All right. Thank you so much, panelists, for your insightful discussion. My understanding, I wrote it down. This was originally going to be directed to Mr. Shagu, but I believe everybody had said something about these things, so maybe anybody can answer this, please. My understanding of this question is about the governance dimension of affordability, and this is in line with what this gentleman has said. It's about dimension of affordability and consumer protection. In practice, a lot of low-income Nigerians genuinely need credit, but they face very high interest rates. And I'm on the internet a lot. You see, even when you're playing a game, you're seeing somebody owe cash or whatever they're trying to lend. But however, you see so many people coming on the internet saying that they are unable to pay their debts, they are unable to pay the loans that they have borrowed. Sometimes they collect 50,000 naira, and then they end up paying as high as 200,000 naira. And there's a lot of embarrassment. Sometimes they're sending messages to their family members, obituary messages. There's a lot of harassment going on. How are the lenders getting protected? Thank you.
Okay, so we'll take the answers to these questions.
So I'll try to combine the 2
yes, please.
questions together. You see, the reason you have high interest rate most times is because the lenders also don't have confidence in repayment. So if I'm availing 10 credit, for example, you're sure maybe not more than 5 of those will come back. So you're charging a premium on those that will pay back, so that you're able to cover for the loss at the end of the day. No, I'm not saying that's a good credit system. I'm only saying that I'm trying to say that most lenders charge a premium because of the high default rate. I don't know if that makes sense. No, hold on.
Please, can we have the room? Please, let's have the room.
So what I'm saying is this: for us to prevent such practices, what we need to do is to have a system that ensures that even when the gentleman said guarantors, yes, guarantors are there, but it's only the guarantor that's the money that will pay back. Most guarantors will not pay. So that's what we're saying, that what can work is for us to have a system that gives the lenders confidence that if I give you, avail you credit, at the end of the day, the system will compel you to pay back, except in a situation where it is obvious that the system has gone, the business has gone bad, and there was no way repayment would come. So to also add it to what you asked, it still boils down to having a credit, maybe like a credit bureau, where we can have governance, and we can have justice dispelled in no time. Now, going to the court is cumbersome. You won't get, the court is already running slow as it stands with all manner of legal issues. But we can have a system where a particular agency is backed by law, just like Professor has said severally today, when they are backed by law, and then when you have those kind of disputes, you can run to them and you know that they will dispel justice on that issue immediately. Now, let me say something fast. Most times when people default, it's not like they don't have the money. When I was in the bank, I was in commercial bank, we went on a loan recovery drive, and a customer sent dog after us. Myself and GM at that time, everybody bailed out. Now, what I'm saying is this: that man has the money, but he doesn't have a system that will compel him fast to make the payment. He eats, he sends his children to school, right? So he has money. So it's a matter of priority. Where do I push this money to? But if there's a system that can compel him to make payments and fast too, at least under some, we can negotiate it, but he would make the payment at the right time.
Okay, so Lady Tino now. Do you do you share risk? Do you share profit? How do you make your money?
We don't share profits. So,
please, can we have the room?
So, what we are after the underserved. There are a lot of MSMEs out there that have viable business ideas, viable projects, but they cannot approach the bank for credit because the bank would ordinarily not want to lend to them because they don't have collateral. We're saying to the bank that do your due diligence. The bank will do their due diligence. I will also do my due diligence. We have a robust risk department that actually assess everything you bring to us. So it's not just, we just want to, share risk with the PFI and then like a charitable organization. No, we have to also preserve our capital. But what we're saying to them is, don't worry, you've looked at this. Your regulators will not even allow you lend without collateral. We're having to hold something. We have looked at it. We've looked at the business. We see how viable the business is, and we're willing to share this risk with you. Another thing that the system needs to look at is data. Because when we have good data, we can underwrite better. Data will show that I can lend to this person. This person has a good credit history. This person, if I give you the money, you'll be able to pay me back. But if I don't have good data, I won't be able to underwrite properly. But if I have good data, I can even tell the bank that, look at the footprints. It's clear that if you give this money and I put my guarantee, I layer my guarantee on this facility, this borrower would definitely pay me back. So we're not a charitable organization. We're only trying to help MSMEs that don't have collateral or that have weak collateral. I don't know if I'm making sense.
Okay, I'd like Mr. Okando to answer the question on the interest rates that you asked.
Okay, thank you very much.
Very briefly, sir.
Yeah, so the banks exist as part of the larger macroeconomy. Any day the bank opens its office, they run generator 24 hours. Even when they are not open, the generator is running, right? So you also have the banks providing their own security because of the nature of the country where we are. So they are spending a lot on security, they are spending a lot on power, they are also spending a lot on technology and several other infrastructure. By the time you decompose these things to percentage, already their cost is accounting for at least 20% of operations. That's just a simple way to understand it. The good examples of Japan, Germany, and Eurozone countries where interest rate is below 5% is because these basic infrastructures come at very, very, very low cost. That is a fact, right? By the time this bank needs to cover its cost of operations, and I've not even talked about the cost of your deposit. The gentleman that raised the question has his money in deposit. He's being paid double-digit interest rate today because, again, you demand a high interest rate on your deposit. The simple economics says you take on one, add a margin to it, and give to the other. That's just the simple basic economics. So it's a factor of several things. Is there hope for reduction? Yesterday, the Monetary Policy Committee sat and they retained all the rates, right? At the CRR, MPR, and all other rates were retained. The indicator rate is 26.5%. That is a basic rate where lending begins to happen. So the bank is a commercial concern. They are in business to make money and also support the economy. While we appreciate the need to lower interest rates, it's actually outside the control of the banks. If the economy, the society reduces the daily cost of doing business, and the bank is not in that, the tailor is facing the same cost of power, right? The manufacturer, the bread baker is facing the same challenges. By the time we as a society go through a period of restructuring and eliminating the structural dislocations in our economy, we'll all be the better for it. Thank you.
Thank you very much. I am so sorry we are going to have to stop this at this point because a few other things must happen in the next few minutes. And so I'd like to thank my panelists for your time and for your contributions to this very, very interesting conversation. Please, can we appreciate them for me? Thank you all so much.
Thank you so much for that engaging conversation. It's the reason that we had lots of questions because you have dealt with the subject matter so well. Right now, we are going to come to some closing ceremonies as we come to the end of the National Corporate Governance Summit 2026. At this moment, did you say something, ma'am? Okay, so they are taking photographs. Now for appreciations, I want to invite once again the never tired president of ICSAN to come do the presentation of the appreciation plaques. Please appreciate her. Thank you.
Good afternoon once again. Another round of applause. To think that at this time of the day, everyone woke up and had so many questions. And please don't take your questions home. Please send it to the planning committee and they will definitely engage the panelists so that your questions will be answered. That's why this National Corporate Governance Summit was held so that we can stimulate that conversation. So let me start by thanking Professor Chris Analo, FICA. Onalo, thank you very much, sir. When you started out, you gave a very robust picture of the credit-based economy. And that flowed into the conversation that took place during this discussion. So thank you very much for attending and for your very, very in-depth outlook. Thank you, Mrs. Hilda Unko, ACIS, for connecting the dots with the panelists. We wish we could continue the whole day. I'm sure if we had taken the next round of questions, we would have had more. And this shows how this session resonates with the people in the room. So thank you for making sure that the conversation was fluid and flowed, and also connecting with the audience. Mr. Sheyi Ashagun, thank you very much. Also for your perspectives that you shared, Mr. Okandu, thank you. And of course, Mrs. Tinu Aguedo, thank you very much. Apologies for literally murdering your name. Thank you very much for your perspective. And of course, your agency is so young, yet at least it's interesting to see how well it's structured and the impact that in the coming years it will make to the credit ecosystem. So on behalf of the co-conveners, we want to present to you plaques to say thank you. And of course, hopefully in the future, we'll invite you back. And then the news will be very positive. And hopefully we won't have people calling people and their next of kin and everyone else. Thank you. On behalf